Over the last couple of years, billionaire investor Bill Ackman has been banging the drum on why he owns Fannie Mae and Freddie Mac shares, so much so that I thought at the end of last year that it was a persuasive thesis and that these might be the best stocks to own for 2025. Since then, Fannie Mae and Freddie Mac are up around 200 to 300%. I personally have bought a small stake in Fannie Mae, FNMA. And now, Dr. Michael Burry sharing on his own private Substack that he owns shares in Fannie and Freddie and his long thesis in terms of why he owns the Fannie Mae and Freddie Mac shares. So it is interesting to see these super shrewd investors get involved with Fannie Mae, Freddie Mac. In some cases, they've owned them for years, providing historical context. It's an incredibly complex situation. I'm going to try to boil it down just to the key points. As I already mentioned, full disclosure, I own shares in Fannie Mae. It's not a huge position, and we'll talk about that why. But I think these successful investors, billionaire Bill Ackman, Dr. Michael Burry, their key reason for owning this comes down to the asymmetry, seeing something that they think could have hundreds of percent upside and say, yeah, if it doesn't work, you lose 100%. So if you have that sort of types of bet and you truly believe, yeah, the odds are, let's say 50-50, that sort of framework, even if sometimes you lose and the 50% comes up and you get wiped out, that if you have it across enough bets, it works out over time because of that symmetry. Because that, hey, well, if you're really right about 50-50, and maybe you're actually closer to 70-30 or 80-20. So that's really the question of what's going on here. And I'm curious to hear your thoughts on what do you think are the probabilities that this works and doesn't work, in the future? Because some investors are saying, hey, this is the next big long because of, the dynamics that we're going to talk about in this video. My name is Daniel. You're watching Unrivaled Investing. So Michael Burry also publicly tweeted sort of sharing the key highlights from his post. I actually am a subscriber to his private Substack. I highly recommend it. A lot of people don't like Michael Burry because he had a history where he said sell, and then he posted that, hey, I actually don't think this crisis is going to be as bad, or it's not going to, the signs aren't there that it's going to get worse. And he was talking about the, recent regional banking crisis, I believe in 2023. And so a lot of people focused on that sell point, and the reality is, I don't think he held on to it. And I also, as I've called out before, I think he's just one of these types of investors that focuses in on issues that a lot and will do the analysis, the detailed work, going through thousands of pages of documents to really understand, come across these little nuggets that says, hey, this is why I think this thesis will work. And that's part of the reason why he was able to see the Big Short when many others didn't. He's not the only one, but he's one of the few. And so I do enjoy following him. So if you are interested in supporting him, I think he's giving 5% of his subscription to charity each month. You can check that out. I believe that's Cassandra Unchanged. And the Cassandra title comes from, I think, Warren Buffett referring to him as a Cassandra, someone that predicts bad things potentially. And so this is what Michael Burry publicly tweeted, sharing the thesis about Fannie Mae and Freddie Mac, talking about how President Trump is excited to get the big home builders going, talking about 2 million empty lots. So he needs to juice, this home building economy, this market. And so he's clearly in a hurry to get the government-sponsored entities, Fannie Mae, Freddie Mac, forcing the issue in the U.S. housing market again. Burry calls this populist ignorance, but, viewing it as you don't want the government overly pressing the accelerator on this because this is actually what led to the issues in the first place. Nevertheless, this is, something that's going to require that they have more capital because they cannot aggressively expand their retained loan books, launch new products, or lower fees, i.e. the rates, the fees that home buyers pay and the mortgage insurance fees that ultimately are tied to it. So they can't lower fees until they have more capital. And so this directly ties to, being working capital constrained and needing to issue capital or deal with the capital ratios that they have. So if President Trump truly wants to get the home building cycle going and juice it up, you're going to need to make sure the Fannie Mae, Freddie Mac, the GSEs have plenty of capital. And he's also saying the time frame might actually be a lot sooner than folks are expecting, talking about the first half of 2026. Previously, President Trump even tweeted about how he was expecting to have some sort of merged entity, the Great American Mortgage Company, that would combine Fannie Mae and Freddie Mac. He was talking about doing that in November 2025. Clearly, that's it's easier to create AI generation images of clapping on the New York Stock Exchange than it is to actually solve these problems. It's actually very, very tricky. You don't want to mess it up. If you mess it up and you don't do it in the right way with the right steps, you do have the potential of causing mortgage rates to go higher, or the fees that people end up paying for their homes to go higher. So it is a very delicate issue that needs to be solved intelligently, saying, hey, it's still going to have this government support, and yet we're still going to be able to lower the fees that effectively these entities charge. And so therefore, sort of encourage the home building market. So let's understand the core thesis when we're looking at Fannie Mae and Freddie Mac, because I think it really does boil down to three key items. This is an incredibly complex thesis, as I've already mentioned. And when we, go through trying to boil this down into the three key items, it's the senior preferred stock treatment, it's the capital ratio, and it's how much the government owns via warrants, dilution. And so Bill Ackman has talked about this repeatedly, talking about when the U.S. Treasury got involved in 2008, it was through a commitment of around $100 billion in preferred stock each. And it gave them warrants so that way they could own about 80% of the company, and that the terms of this senior preferred stock was a 10% cash rate or 12% if you can't pay in cash, so paid in kind. So it just compounds. And so they originally couldn't pay because of the great financial crisis, because they effectively insured a bunch of crappy loans, a lot of ninja type of loans, and no income, no job, a lot of adjustable rate, a lot of subprime loans. And so they couldn't pay it. But they subsequently were able to the point where they actually repaid all that they borrowed from the Treasury. And if you look at all the money that has been swept to them, it's actually closer to a 12% return versus the 10% original dividend rate. And so the U.S. Treasury has received around $25 billion more than what was contractually owed when the deal was originally set. Now, another key aspect to the thesis is the fact that the capital requirement. So that's point number one. Point number one, saying, wait a second, the original term was 10%. Then President Obama created sort of a cash flow sweep, and they weren't able to build up capital. And so because of that sweep, they actually ended up overpaying. And President Trump has said, wait a second, that wasn't legal for you to create this cash sweep. It doesn't make any sense. So he nixed it at the end of his last term, Treasury Secretary Mnuchin. And so now, so that's the first one, saying, hey, doesn't this strike you as being repaid? Because the deal term was a 10%, and you get warrants for 80% of the company. That was the deal, and you ultimately paid back closer to 12%. Okay, that seems like a win for the U.S. Treasury. You made money. So then the next question is, okay, well, how are they capitalized? Because before the crisis, this once again from Bill Ackman's presentation, they were closer to 0.5% in terms of capital to the underlying obligations that they're insuring, versus now it's a much more conservative, impractical level of around 4% capital to their obligations that they're insuring. And, Ackman's making the case, wait a second, this doesn't make sense, because if you look at banks, they're closer to 4%. So why should the GSEs, which don't have as much risk as banks, have to have, closer to a 4% rate? Doesn't it make sense to have closer to a 2% rate? And, it's also worthwhile to understand, thinking about this 4% rate versus the 2% rate or 2.5%, that's going to be decided in the next few years. We'll talk about why it's very likely to be decided in relatively short order. The reason why you can't just say, oh, okay, well, let's just keep it at 4%. What's the big deal? Is the higher the ratio in terms of capital that they have to keep, that means ultimately Fannie Mae, Freddie Mac are going to need to have that cash on their balance sheet. That's going to require an even bigger IPO, talking about tens of billions of dollars. And so if you have a situation where you say, you know what, the capital ratio only needs to be 2% versus 4%, as long as you're only underwriting or you're insuring this mortgage pool, then that's very safe. Then that 2% makes sense. But once you start expanding to more risky products, then yeah, you absolutely need to consider having more effectively equity cushion. So that's really what it comes down to is if you say, hey, we're going to need to keep this 4%, threshold, this capital ratio, it's probably going to also mean that these entities are going to struggle to make a good return on investment, and they may also have to raise their fees, their guarantee fees, which case it impacts all the home buyers. Whereas if you're able to lower the capital ratio, it's lower fees for all those home buyers. So there is that dynamic. So it directly goes to how much money they need to raise and the fee structure. So these both, if you believe President Trump wants to juice the economy with the home building cycle, you would suspect, hey, maybe it does make sense to go closer to 2, maybe 2.5%. A lot of it also depends on what does the current Treasury Secretary, Scott Bessent, think about these issues. So, and then another key aspect, is understanding the dilution. That's number 3. So the Treasury, U.S. Treasury, U.S. government, got 80% of both companies via the warrants. The question that some folks are suggesting is that, well, wait a second. With this senior preferred stock, they could then, if the government says, you know what, we're gonna treat the cash flow sweep under President Obama as totally fine. That didn't actually repay the senior preferred stock. Then what we're going to do is we're going to say, you know what, instead of the 80% that we own, we're really supposed to get closer to 100%. We're going to convert the senior preferred stock plus these warrants. So we're really closer to 100%. So all those legacy claims, the original 20% of the pie, the original shares, which based on the original deal in 2008 suggested, hey, these shares will own 20% of this company after this Treasury investment. It's really a question of, well, where does the government sort of finally land on their ownership? Now, the argument that Burry and Ackman are both suggesting, which is that it seems unlikely that the government's really going to push to go for 100% or significantly more than 80%. Because, first of all, the upside downside isn't worth it for them because they already got 80%. There's no arguing about that. The original deal, the 2008 deal, was for 79.9%. And so if you say, you know what, it really should be 95%, then it opens you to more litigation. Litigation makes it harder for you to do a multi-billion-dollar IPO. So these are the dynamics that go into understanding the thesis for Fannie Mae. So the question is, and Freddie Mac, the question is, where does it potentially go from here? What are some of my thoughts as I reflect on these GSEs, the government-sponsored entities, Fannie Mae, Freddie Mac? First of all, none of this is financial advice. In full disclosure, at the time of this video publication, I do own shares of Fannie Mae, FNMA. I bought them via Interactive Brokers. See the link below. Also, Francisco, a premium subscriber, wrote, in these 2 years, I've not only built a profitable portfolio of solid companies that outperform markets in turmoil, and of course paid for this subscription, it's both the closer you can get to a mentoring from a value investor and a good community to pick bright brains, even with their own different journeys. He's talking about unrivaled investing. If you're looking for compelling ideas, come check it out. I recently was buying a stock earlier this week that I think has roughly 300% upside potential. We'll talk more about that in the weeks ahead. So as we think about Fannie Mae, Freddie Mac, I think it is important to reflect that every investor is going to have a different journey. And so what might be right for me, what might be right for Bill Ackman, Michael Burry, everyone has a different journey. And the reason why I'm sharing this is because you need to figure out what's right for you. None of this is advice. It's you need to understand, okay, what are you comfortable with? What will you, if you all of a sudden saw that Fannie Mae lost 80% of its value, would, it fundamentally change your life story? For me, if that happened, it would not fundamentally change my life story. I would say the bet didn't work out the way I expected. Now, you might say, wait a second, Daniel, usually you have this checklist here that you talk about: management alignment, obvious growth, compelling valuation, limited blow-up risk. If you're talking about an 80% downside potential or something like that, isn't that real blow up risk? So the way I think about it, and keep in mind, all companies go through that checklist, is that most of my portfolio, I'm running through that checklist. Whether or not it's a microcap company or trillion-dollar company, they all go through that checklist. That said, I will keep a portion of my portfolio, not the majority, for interesting situations, special situations where I think there is that sort of symmetry and it's about me enjoying it, where I go, yeah, I like it. I think it's interesting. That's why, when I saw Bill Ackman sort of banging the drum saying, hey, I think, this is going much higher, got me interested, looked at the presentation. I said, yeah, this makes sense. Plus, President Trump has pretty much said that he's interested in doing this. And then he creates this, he's on the New York Stock Exchange, rah, rah. So I see this, I go, yeah, this, it's part of my special situation, part of the portfolio that I go, yeah, it doesn't clearly fit the checklist, but it does have that sort of asymmetry. And certainly when I was buying it, start of this year, it had much more asymmetry. Now I think it still does, and we'll talk about that right now in a second. But I think it is, before going into that, before going into the framework, it is worth calling this out, which is, reading Burry's article reminded me of this, is that the warrants that the government got in 2008, they expire in September of 2028, which is before President Trump's term is over. So the odds, even if you were to say, hey, I can't believe, the first quarter of 2026 or the first half of 2026, they previously said November. So, why should I believe that they're going to get anything done? The warrants for that original 80% expire in September of 2028, which is before President Trump's term is over. So, in my opinion, the government's not going to leave 80% of these businesses that are worth hundreds of billions of dollars. They're not going to let that just poof expire. That Treasury Secretary Scott Bessent is too sharp for that. That's not going to happen. They're going to do something. And so the odds of something happening in the next few years, in my opinion, strike me as very high. And this is why this gets to the start of this video conversation. What do you think the odds are? What do you think are the odds that it cuts favorably for the legacy shareholders of Fannie Mae pre-crisis? And so given this sort of calendar, I do understand the aspect of, if they don't show progress on an IPO in 2026, there is legitimate risk that sentiment will just be like, oh my gosh, we're back in the doldrums. Where's this stock going? Maybe it loses much of the gains that it has so far this year, this 200%, 300% rally so far this year. But still, the government's going to do something, very likely, by 2028, saying, you know what, we're exercising these warrants. We're going to resolve this because we have to. So that is an important aspect to consider. When we think about, where it potentially goes in the years ahead, my framework is actually pretty similar to what Bill Ackman laid out here, because in my opinion, it's less relevant what you think the multiple's going to be. 16 times, 20 times earnings, 25 times earnings. That frankly doesn't matter as much as what stake, how big do you think the government's stake is going to be? And that's really what this comes down to, is if you think the government's going to say, hey, that senior preferred stock, it's been repaid. Really, we own 80% of these entities and the legacy shareholders have 20%. Then there's a situation where this is a $40 stock. That's a possibility, depending on what sort of multiple you're using. In this case, Bill Ackman saying, I think $15 billion in earnings power for Fannie Mae and 16 times multiple. Once again, doesn't matter, in my opinion, if it's 20 times, 15 times. Ballpark, this is effectively a utility type of business, especially for their core business, which is focused on this, effectively insurance for quality mortgages. It should be like a utility. So I look at this and think, yeah, there is still this asymmetry that this could be a $40, $50 stock, depending on sentiment, depending on how much the government takes. Stick to the original terms of the deal. 80% makes sense to me for the government, especially given the upside downside of you open up a whole can of worms of potential litigation if you try to push for a lot more than that. And so then, you're talking still about significant asymmetry. Whereas in a scenario where you might say, well, there's going to be some sort of conversion and the government might actually get closer to 95%, any situation where you start talking about the government still owning 90% plus and the legacy shareholders only getting, let's say, 4, 5, 6%, then you are talking about going back into a low single digits type of stock price. And here Bill Ackman saying it's closer to $5 per share for the legacy shares. So, a significant haircut. This presentation, I believe, is from the start of the year, so before the rally. So these percentages are off a bit, but it still gives you a framework to think about, how this might perform, in the years, possibly in the year ahead, if this gets unlocked, which is, how much do you think the government is ultimately going to own? What do you think are going to be the capital ratios? Do you think the government truly is incentivized to stir up the home building economy? And, if you believe all these things sort of check out, hey, the government is incentivized. They want to get this done. They need to be able to raise some capital for these institutions, and they want to, juice the economy. If you're going to factor in all these pieces, there is a good chance that this ends up at a, $30, $40, $50 per share. Recognizing this is a special situation, it also depends on what does the administration, want to push for. Do they, want to push for politics and say, hey, we own 100% of this, in which case you do have litigation and you do have, effectively the share price maybe goes down to $1 or less. So that is the framework that I'm thinking about with Fannie Mae. Most of my positions, I'm not thinking about this sort of, hey, I could get wiped out. And for me, because of that dynamic, it's a smaller position. It's a, I don't want to wake up one day and be like, oh my gosh, this is a donut. I don't think it will be. It is a risk though. So if you look at my top positions, I'm saying, yeah, I'd be very, very surprised if there's a material impairment over here. And you have in the top position, you have a multi-decade history of really, outperforming the market and, a Fort Knox type of balance sheet. So I hope this video has been helpful walking through the thesis for Fannie Mae Freddie Mac. Thanks so much for watching Unrivaled Investing.